Hey everyone, welcome back to Corporate Decoder. Today, CRH just filed an 8K about new financing, and I am seeing a big shift in their strategy that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. CRH has secured a new big loan and is reducing another, which tells us a lot about how they plan to pay for their big Arcosa acquisition. So CRH, a major player in building materials, is gearing up for a significant acquisition of Arcosa Inc. They announced plans to buy Arcosa back in June of 2026. Arcosa makes specialized equipment for transportation and infrastructure markets. This is a pretty sizable deal that CRH is looking to close. To pay for this, CRH initially lined up a massive $5.75 billion bridge loan. Think of a bridge loan as a temporary loan to cover expenses until more permanent financing is in place. Now, in their latest filing, they've announced a key update. CRH has secured a new $2.5 billion term loan facility. This is a 3-year loan, and it is a good sign because it means they're locking in some more stable, long-term financing. Because they've secured this new $2.5 billion term loan, they've reduced the amount they can borrow under that initial $5.75 billion bridge facility down to $3.25 billion. This is a smart move. It shows they are actively managing their financing and reducing reliance on the more expensive or potentially less certain bridge loan. Let's talk about the cost of this new money. The interest rate is tied to SOFR, that is the secured overnight financing rate, which is a common benchmark for short-term interest rates. It is SOFR plus a margin, and that margin depends on CRH's credit rating. Companies with better credit ratings get lower margins, meaning they pay less interest. Something interesting here is the ticking fee. This is a fee you pay on the part of the loan that you haven't actually borrowed yet. It starts at zero, but it gradually increases over time if you don't use the full loan amount. This incentivizes CRH to pull down the funds when they are needed, rather than just holding onto a large unused loan facility. It is a common feature in these types of agreements. The filing also mentions that this new loan has typical terms for companies with good credit, what they call investment-grade borrowers. Importantly, there are no financial covenants. This means there are no specific financial performance targets, like maintaining a certain debt-to-equity ratio that CRH has to meet to avoid defaulting on this loan. That is a good sign as it gives them more flexibility. CRH is also planning to replace the rest of that bridge loan with other financing options before the Arcosa deal closes. This suggests they are confident in their ability to secure whatever funding they need. They expect these alternative financings to have standard terms and interest rates based on what is available in the market at that time. This is a bit of a heads up that the final cost of their borrowing could change depending on market conditions. However, they are also being careful to say there are no guarantees about when or on what terms these other financings will be finalized. This is standard language to manage expectations. Ultimately, CRH plans to use a combination of this new term loan, whatever remains of the bridge loan, and potentially other financing along with their own cash to complete the Arcosa purchase. Now, like most filings about future events, this report has what are called forward-looking statements. These are basically educated guesses about what might happen. They use words like will or expects, and they are based on current information and assumptions. You'll see phrases like will anticipate, should do this, or expects that. It is important to remember that these are predictions and things can change. They've listed a lot of potential roadblocks. Things like Arcosa's shareholders not approving the deal, not getting regulatory approval, or even just the deal disrupting CRH Day-to-day business. Economic conditions like changes in interest rates or inflation are also big risks. They also point to their annual report for more detailed risks. This is a crucial reminder that acquisitions, especially large ones, are complex and often face unforeseen challenges. Comparable to this kind of financing announcement where a company is securing debt for a major acquisition is often seen when companies like Home Depot or Lowe's are expanding their footprint through new store builds or acquisitions, though CRH deal is more about consolidating market share in the building materials space. The report is signed by Aylwin Bryan, the Chief Financial Officer, which is typical for these kinds of financial disclosures. My take on this filing is that CRH is making solid progress on financing their Arcosa acquisition. Securing a $2.5 billion term loan while reducing their reliance on the bridge facility is a positive development. It shows financial discipline and a move towards more stable, long-term debt. The lack of financial covenants is also a good sign for operational flexibility. The biggest risk I am watching is the successful integration of Arcosa into CRH's operations and whether they can achieve the projected synergies from the merger. The filing itself acknowledges the many factors that could derail the deal, and that is always a concern with large acquisitions. What I am most eager to see is how these financing costs translate into the company's actual financial performance post-acquisition. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.